Oh, she's here. Thanks, Megan.
Good morning, everyone. Thanks for joining us today for the second session on track 2 of our R3 cohort 3 grantee training. Now, last week we talked a little bit about executive compensation when it's charged as a direct cost to the agreement, and we made some reference to indirect costs. But today we want to drill down a little bit more. We want to talk a little more detail about documenting your expenses for your new R3 grant, and we're going to go into greater detail on indirect costs. So let's get started. So as we say every week, our microphones are muted, so we're going to keep you muted throughout the presentation. That doesn't mean we don't want to hear your questions. We don't want to hear from you, but we are recording this session, and so we want to have a really high quality recording that we can send to you afterward. So we're going to ask you to use the chat box instead to give us your questions, and we're going to stop periodically to address those. So as I said, we're being recorded, and after the session, we're going to be sending a follow-up email to everybody who's on our contact list. So if you received an invitation directly from us, you're on our contact list. But if you received a forwarded invitation, we want to make sure that you receive the follow-up as well. So please use this email address, cja.r3training@illinois.gov. To request being added to our contact list, or request that other folks in your agency that need some of this information that we'll be presenting can be added to our contact list, so they'll receive invitations directly and they'll get the follow-up information as well. So if you are requesting to be added to the contact list, we ask that you use that email address and give us the staff member name, their role in the grant, and their email. So we have 3 big topics to discuss today: maintaining your documents, documenting expenses, and, as I said, detail on indirect costs. So let's talk about maintaining documents. When you receive your grant agreement, you will see this language in one of the sections. It says that the grantee shall maintain for 3 years from the date of submission of the final expenditure report all adequate books, all financial records and supporting documents, statistical records, and all other records pertinent to this award. So that's 3 years after you send in your closeout agreement. So if your grant runs the full 3 years, that's allowable under GATA. So that would get us to October 31st of 27. 3 years after that date, you have to maintain all of the documents that you have, including all the supporting documents for the reports that you turn into us. All of those have to be maintained until that's going to be October 31st of 2030. So we want to provide you this information up front so that you can prepare to make sure that you meet this requirement and you maintain those documents throughout the life of the grant. Now, we also want documenting expenses. You have to maintain documentation for each expense that's charged to the grant. And there are 2 elements to that documentation. You have to be able to prove that the expense was incurred and prove that that expense was paid. So one of the ways that we often are going to be reviewing this documentation and the adequacy of the records that you're keeping. You're going to have a site visit during the first year of your program. We have a session later on in a couple of weeks where we're going to go into detail about what happens at those site visits, but you will have a site visit during the first year of your grant. And one of the things that we look at during a site visit is the adequacy of your backup documentation. If you're audited, the auditors are going to be looking at the adequacy of that documentation. We periodically do PFR reviews. The PFRs are the periodic financial reports, the expense reports basically, that you will be submitting throughout the life of your grant. And periodically we will select a grant for our fiscal office to do a review. So they're going to be asking for this backup documentation and making sure that you are keeping adequate records and that all of those costs that you are charging to the grant are allowable. Our working capital expense, we have 3 dispersal methods under this grant. Not all grantees are going to be eligible for all 3. We're going to talk about that tomorrow in our Thursday session and give you the detail about these different dispersal options. If you select the working capital advance dispersal option, we will be doing an expense documentation review within the first 6 months of your grant. And that's not meant to be punitive in any way. None of this is meant to be punitive. Our job is to help make sure that you are aware of and keeping within all of the guidance that's required for your grant agreement. So we'd like to do this as early as possible. We wanted to give you this information early in the grant execution phase to make sure that you are set up and you start this grant on a good footing and that you'll be prepared to keep adequate documentation throughout the life of your grant. Now, we have developed just within the last year or so a tool that we call the ICJIA Financial Documentation Report. And we use this in all of those ways that we were talking about, like when we are preparing for a site visit. We will we'll select a month of your program operation. We'll ask you to email us PDFs of the backup documentation so that we can review it and see if there are any red flags that pop up, so we can discuss that during your site visit. But it's also, we're going to actually send you a copy of it with our follow-up information this afternoon, so that you can see like how we will be reviewing this documentation. But it's a powerful tool to help you, and it's a simple tool, but powerful to help you assure that you're maintaining that adequate documentation of your grant expenses throughout the life of the grant. So I'm going to stop sharing my PowerPoint and I'm going to share that tool so you can see what I'm talking about.
Are you okay to take some questions now while you're pulling up your tool?
Yes, ma'am.
Okay, first question, is travel considered an expense?
Yes, if it's in your budget, sure. Let me stop that. Sorry.
Second question, can receipts serve as proof that an expense was occurred as well as proof that it was paid?
I'm going to go through that right now with you, show you what documentation we're looking for. So I'll get to that in a second.
All right, that's it for the questions.
Okie doke. I'm trying to get over to the right file here. And sorry, it won't let me bring it up. I apologize. Hang on 1 second for me. It wants to show you something else. Sorry about that. Nope, that's not the one either. I brought up too many files all at the same time. Sorry about that. Usually a little smoother than this. So you should, Aisha, can you see the financial documentation report?
Yes, I can.
Great. So it's really just a pretty simple Excel file. It's got a bunch of protected formulas in there, but it's really pretty straightforward. So I've actually completed this based on like a sample grant that I'll show you later on. So this cover page, all of these cells that are white are formulas. It's grabbing information from other tabs. So this is kind of the summary. We have a separate tab for each budget category, and you should be able to see that we have we're wanting to see that each expense that's charged to the agreement is listed, and the amount that's charged to the agreement. This column has a pull-down menu where you can select whether this expense is a direct expense or an indirect expense. And then you'll see these columns, and it's going to change a little bit for each of the budget categories because there's going to be different budget backup documentation that we'll be looking for based on the budget category. But for personnel, we're going to want to see a payroll register. You want to see that Sheila Johnson actually did work on the grant during this period. So we want like a payroll register, timesheets, things like that. But we also want to see that you actually paid Sheila. So this is documentation that you incurred that expense, that Sheila did the work on the grant. In this column, where you're selecting either a cost center or a general ledger, some accounting of what expenses were paid out, this is where you're going to be documenting that you actually paid Sheila for that expense. So you incurred the expense and you paid the expense. Very similar for the fringe benefits. You'll see that I wrote down that Sheila had worked that grant. She was direct expense. This is her FICA on this line item. Here's the health insurance on the next line item. They're both direct expenses. The payroll register proves that you incurred that expense, and the cost center or general ledger proved that you paid that expense. Travel's a little different. So let me go over here. So Sheila is authorized to do local travel at 67 cents a mile. On the 13th of November, she traveled 10 local miles. So you owe her $6.70 in a direct expense. And she submitted a travel reimbursement form to document that she did that local travel. And in this case, you have both the cost center or general ledger, but you also have a canceled check. You issued that $6.70 check to Sheila for her travel reimbursement. She took it to the bank. Now you have a canceled check as well. For equipment, in the sample budget I'm going to send you this afternoon, you'll see that we have authorized a printer scanner for $6,000. I have an inventory number to track where that piece of equipment is. The amount expended was a little bit less than the budgeted amount of $6,000. It was a direct expense, and I can prove that I incurred the expense because I have the invoice, I have my cost center, general ledger, and I have the canceled check where I paid the supplier for that piece of equipment. Now I've got supplies, very similar thing, 4 reams of paper to use. That's the cost, direct expense, invoice, and so on. So I won't go through each of them because I'm going to send you this blank form that you can use, and you can see the kinds of backup documentation that we're expecting to see for each expense that's charged to the agreement. It looks like there are a number of questions in the chat, Aisha.
Yes, ma'am. So the first question is, we have a fund accounting software subscription. So our expenses are allocated based on the fund/grant, which is like a cost center, but it's different. Will that be okay for reporting purposes?
Absolutely. As long as you can provide some document that will prove the costs that were charged to this agreement, that's going to tie to the financial report that you're going to turn in for reimbursement. As long as we can tie those pieces together and you can prove that you actually expended those funds and incurred that cost, you're in good shape.
All right, next question. What if salary is direct deposited, so there is no canceled check?
But you should definitely have you don't have to have a canceled check, but you need to have, like the previous question, you need to have some accounting system, your bank statement, your cost center report that proved what the outlay for this grant was, and that it's directly tied to this grant. You can allocate it to this grant.
All right. Sorry, I'm a little confused. Are we supposed to list each staff salary and fringe separately?
Yes, if you're completing this form, and like if we're going to ask you for backup documentation, we would expect you to, we'll ask you to complete this form. They're only going to ask you for a sample, right? They're not going to ask for the entire grant. But they'll say, oh, your start date of the agreement was November 1st. And so maybe next spring, they're going to say, send me the documentation for December of 2024, and just, scan all those documents and email it to your grant specialist with this form so that they can check off. What they're looking for is to make sure that all the costs that are charged to the agreement are in the budget, that approved budget that you have, and that all of those costs are allowable, and that you have proper documentation. And I'm actually going to say that when we started using this as a tool to prepare for site visits, we did find it was not exceptional that folks listed expenses that were charged to the agreement that weren't in that final budget. And, we'd ask the grantee about it, and they'd say, oh, yeah, but I really needed it. Yes, then you needed to do a budget revision. So the only costs that can be charged to the agreement are those that appear in that final budget, which is part of your grant agreement. I think I answered the question. What's next, Aisha?
The next ones, our employees track mileage and submit reimbursement through an app. Will that suffice?
You should have you can get some report from that app. Is that correct? You must have some documentation from that app that you should be able to supply us, to supply an auditor, when they're to make sure that it's done correctly. So it doesn't have to be a physical piece of paper.
Last question. Do we need to fill out the expense listing we just went over for each month, or is that only in preparation of a site or accounting review?
Yeah, it's just, this is a tool that you would use for one of those reviews. But for some grantees that may be new to this may be, at least initially, a way for them to make sure that they're keeping all of their documentation. So we're not asking you to keep this for the whole life of the grant. We're not. But we wanted to provide it to you so that you can see the kinds of backup documentation that we would be looking for, because it does vary slightly by budget category. So if you already have a robust system and you understand all this, the backup documentation that would be necessary, you would only complete this when your grant specialist asks you for it. But for newer grantees, at least initially, it might be a tool to use to make sure that you're keeping all the documentation that you need. Ready to move on, Aisha?
Last one.
Okay.
Can occupancy costs be calculated by a dollar amount per square foot? Yes.
Yeah, in your budget, you may be able to do that. So if you have a lease for, a larger space that's being shared by this program and another, in your budget that you're negotiating with your grant specialist now, you're going to be describing how you prorated that lease, those lease expenses to be charged to this agreement. And so we would be looking for, if we're doing the review of your backup documentation, and you have a $10,000 a month lease, and in your budget you show us that 40% of the space will be used by this program, and so you're going to charge 40% of that monthly $10,000 expense to this grant. We're going to be looking for $4,000 on this. That would be the backup to that. And we're going to want to see that you do your monthly rent, that you incurred the cost, and that you paid the check for the whole $10,000. There should be some your cost center should be being able to divide that $10,000 between the $4,000 share of it that's being charged to this agreement, and what other funding source is supporting the other $6,000. So that's why cost centers are important, because you may pay one bill, but it may be an expense that's shared across different funding streams.
All right, that's about it.
Okay, here we go with indirect costs then. So just to review real basically, the difference between a direct and an indirect cost is that direct costs are those that can be directly attributable to the funded program. Indirect costs are those expenses that support the overall agency operation and are more difficult to directly attribute to each agency program. Okay, so if it can be attributable, it should be charged as a direct cost. Here are a couple of examples of what we typically see as direct and indirect costs. So if you have a reentry program and you're hiring a new reentry specialist to work on this new R3 program, that's a direct cost. You can directly attribute it to this program. Indirect costs are those, those overall expenses that are not attributable to each and every program that you operate. So for instance, accounting services that are auditing your agency finances, it would be hard to, to figure out exactly of your, $20 million agency budget, how much is supported, how much of that bill for the, for the audit is for this one program. So that's an indirect cost. Your agency liability insurance is another one that you may not be able to directly attribute to every program that you are operating, your whole agency is operating. Those are the examples that we're going to use in the sample budget that I'm going to send you as well. So as you're negotiating your agreements now, that if you are charging indirect costs to the agreement, that indirect cost tab in your budget has to detail both the election, like what indirect costs are you choosing, the costs that are included in the basis, that's the number that you're going to multiply by the indirect cost rate, that's going to calculate that line item for you, that budget page, and what expenses you're going to pay with those indirects that are charged to this agreement. So now I'm going to try to bring up the sample budget for you. Hang on, it'll take me a second. Do you have any other questions? Oops, that's not where I want to be. Any other questions in the chat, Aisha?
No other questions at this time.
Okay, be patient with me for 1 second while I bring this up. Sorry about this. There it is. There it is. So this is, I'm going to send you this whole sample budget, but this is the indirect cost page. And this is a good example of the way that we want you to detail your indirect cost information in the budget. So here you're going to be telling us what the basis of your indirect costs are. In this example, you're going to use the basis, and I'll explain what that is in just a few minutes. You're only going to charge it on the direct personnel and fringe benefit, so the possible indirect costs that are in your budget. So I've totaled that up and it comes to $366,786. This grantee has elected the de minimis rate of 10%. And so the calculation happens there. And then in the narrative, because we have budget narrative for every single line item in the grant. The same is true for the indirect costs. So we're going to say the indirect costs will be charged to the agreement at the de minimis rate of 10% on total personnel and fringe benefits of $366,786. Indirect costs will support accounting services and agency liability costs. So you have to not only say what tell us how you're coming up with this calculation. It's going to be de minimis, 10% times the total personnel and fringe, But you also have to tell us, now that we're going to charge indirect, what expenses are you going to use that indirect money for out of this, all of these overall agency expenses? Which bills are you going to use this 36,679 to pay? So we're looking for that level of detail. And then when we do this sampling of your budget and you send us the backup documentation, you're going to be filling out that form and you're going to highlight the bills that you pay for your accounting services and for the liability insurance. You're going to be indicating them as indirect with that pull down menu, and you're going to show us that you incurred the cost and that you paid that cost. So now I'm going to go back to my PowerPoint. Now, I do want to note that we just learned that effective October 1st, 2024, that was yesterday, the 2 CFR 200, which are the federal financial allowability rules that the state of Illinois adopted when they adopted GATA, that the feds adjusted some of the indirect cost guidance. And so I will talk about that as we go through it. But I just wanted to note that it is effective yesterday. So we can use this different guidance for the budgets that you are creating right now. So let's back up to the indirect cost election. So there are 4 options. You can not charge any indirect costs to your grant agreement. You can charge the de minimis rate, the yesterday or the September effective rate of 10%. Effective yesterday, the allowable de minimis rate went up to 15%. If you have negotiated a state indirect cost rate, you can elect to use that. Or if you have a negotiated federal rate, you may elect to use that. I do want to note that if you have a negotiated rate at all, if you have a negotiated state or federal rate, you may not use the de minimis rate. Now, the negotiated state and federal rate are the maximum percentage that may be charged to indirect. But agencies with negotiated rates may charge their indirect at a lower rate. I'll give you a good example. Pardon me. I recently worked on another fund on a grant that was $20 million. And this agency had negotiated indirect cost rate of, I want to say it was something like 27%. But in preparation, when they were negotiating this agreement, they met with their accountants and they said, well, we don't have 27% worth of indirect costs that will be paid during this grant agreement. So they identified the actual costs that will be paid out for indirect, this overall agency expenses that aren't directly attributable to the grant. And they actually charged the indirect at a lower rate. It's lower than their maximum, but it has to be an actual expense that is paid during the grant. And so they actually lowered that amount. So as I said earlier, agencies that have a negotiated rate may not elect to use the de minimis rate. You have to either use you have to declare that you're using either the state or the federal rate, though you don't have to use the maximum rate that's allowed. Now, maybe before we dive into MTDC, let's stop here for a couple of questions, see if that information was clear. Any questions, Aisha?
Do individual indirect expense items need to be approved? And if so, if they can change over the life of the grant, will that require a budget amendment?
Okay, so in my sample budget, my grantee has said that they're going to the indirect costs that will be paid from this grant will be their accounting service and their general liability insurance. That's the level of specificity that we're looking for now. When we do a document review, we would want to see bills for those two charged to the agreement when those costs are incurred. If that's what you decide at the beginning, but you find out during the length of the period of performance that you need to adjust what indirect bills will be paid from this indirect that's charged to the agreement, you're going to do a revision, because we're looking for that level of specificity in the budget. And if you change the costs that are charged to indirect, that's attributable to this, or that's included in this budget, you're going to need to change the budget. Now, it's going to be about 4 weeks from now, I think we're going to do budget revisions on Thursday. So we'll walk you through that whole process. But right now, we understand that a budget is a plan, and that there are a number of dynamic factors throughout the life of a grant that we may not be anticipating at this point, right? Maybe you bring on your staff later, or some other cost was not accurately anticipated, that you need to make some revisions during the life of the grant. So we allow for that. But for right now, this is your plan going forward. Were there other questions, Aisha?
Sure. Will all state of Illinois departments be moving from 10% to 15% de minimis? Yes.
Yeah, my understanding is because all the agencies that are on the grant making agencies that are under GATA, they follow the 2 CFR 200, that the federal guidance. And so they will have to follow that federal guidance. But that's the maximum allowable, right? But we'll talk about that in just a second. Any other questions?
Let's see. I listed my accounting and bookkeeping individual as staff. Should I list their business instead as an indirect cost?
If you can directly attribute a cost to this grant, then that's a direct cost. And so we're going to see a line item. If it's not directly attributable to this grant, it's an overall expense that you can't parse out which part of it is for this grant, then it's an indirect cost. So if it's attributable, it's direct. We're going to see a line item for that. If it's an indirect cost, it's overall, and you can't directly attribute it to this grant. So let's think about how an accounting service could be a direct cost. Maybe you've been operating a program and it's been sufficient to have an accountant that works 20 hours a week. Now you're bringing on this big R3 grant, and that's not going to be sufficient time. So you're going to increase their hours to 30 hours. That's directly attributable to this grant, those additional 10 hours of their time, of that accountant's time. If it's an accountant staff person like that, that's directly attributable. I hope that helps.
Okay. So is the elected indirect cost rate generated per line item or to the total grant amount? For example, if we negotiate a 10% indirect cost rate, does that mean only 10% of indirect personnel and fringe benefits cannot exceed 10%, or indirect cost in general cannot exceed 10%?
You're going to, well, let's hold that question for a
For
second.
the calculations, right?
Yeah, let's hold that second, because we're going to go through exactly that question in just a few slides.
And then the last one is, if our indirect costs include 6+ administrative personnel that include leadership, accounting, HR, etc., are you going to want to review every timesheet and payroll detail for each of those personnel, as well as the administrative allocation of joint costs for various line items like occupancy, telecommunications, etc.?
No, so you're going to tell us which of those bills, those 6 administrative people, your telecommunications and all of those other indirect costs, that whole big agency support expense, which of those are you going to pay out of this grant, the indirect from this grant? Now, I would suggest that the simplest way to do it is to identify a couple of those bills that will be paid, not, a very tiny percent of every single one of your indirect costs that's in that pool. Like I did in the sample, I'm going to pay my accounting services that support the whole agency, and I'm going to pay my liability insurance that supports the whole agency. Those are the 2 bills I'm going to pay, instead of paying the executive director, the CFO, the lights and the internet. I'm not going to pay a little tiny share of everything. I'm going to identify which 2 bills I'm going to pay and use the indirect cost that results from this agreement. Those are the bills I want to pay. Now so if you simplify it that way, then it's doable. If you make it complicated and you pay, no, I'm going to pay, this tiny percent of the executive director, this tiny percent of the CFO, this tiny percent of my telecommunications. If that's paid out of this grant, the indirect from this grant, yes, you'll have to document it. So that's why we tell you this up front, so that you can come up with a doable, like manageable way of anticipating which bills will be paid, so that it isn't a crazy complicated thing. Does that make sense, Aisha?
Makes sense to me. You can move forward.
Okie doke. So when we talk about the indirect cost basis, those are the direct costs, that total that we're going to multiply by the indirect cost rate to get the indirect cost, the maximum indirect cost that can be charged to this agreement. It's called the modified total direct cost, so MTDC. Now, again, I've highlighted the 25,000 because that's another part of the 2 CFR 200 guidance that just changed yesterday. But there are a number of things that are always excluded from that MTDC. Rent is always excluded. Equipment is always excluded. And the portion of contracts above $25,000 are excluded. So if you have a contract for $100,000, then only $25,000 of that subcontract would be added into your modified total direct cost, that basis that you're going to multiply by your indirect cost rate to get the indirect cost that can be charged to this agreement. That changed yesterday to $50,000. So to kind of help folks figure out what their total MTDC could be, we've developed this MTDC cost calculator. And so that's going to identify the maximum MTDC that can be, oops, that's a typo, used to calculate, whoops, I went back too far, used to calculate, sorry about that, I flipped ahead there, that can be used to calculate their indirect costs. So I'm going to stop sharing this now, and I'm going to bring up that that cost calculator. And I'm going to close that one. And I'm going to bring this one up. And I'm going to send you this MTDC cost calculator. But because it was just changed yesterday, I haven't had a chance to update it yet for the formulas to be adjusted for these new rates. So you should be seeing the cost calculator now. And you can see on maybe I'll make this a little smaller, on the right-hand side of the screen, we've actually included some instruction boxes to help you complete it. So in the sample budget that I'm going to send along with the updated cost calculator, you'll see that you're going to be entering Like that's your total personnel there. That's your total, whoops, fringe benefits. Sorry about that. That's the total budgeted amount for travel. There's that equipment cost of $6,000. Here's supplies. They have some subawards for the total $100,000. They have a $60,000 rent, and they have another $1,000 for a training contract. You can see there's a tab where you would be listing subawards, right? And it's going to do the math and tell you how much is going to, well, here's the total subaward. That's that's what's allowable, and here's the exclusion. I'm going to go back to that first tab. And you can see that it's going to grab those numbers and it's going to exclude rent, because all of rent is always excluded. And it's going to actually grab that $75,000 from that second tab. That was the amount that was excluded from that subaward. Equipment is always excluded as well. And it's going to add up the total exclusions, and it's going to provide your total maximum MTDC base. Here's the 10% de minimis rate, which I have to update for you. And then it's going to tell you the indirect cost, the maximum indirect costs that can be charged to the agreement. So when you figure this out, and you're going to update the indirect cost tab on your budget, you're also going to figure out, well, what are $39,433 worth of indirect costs from all those things that are included in your indirect cost pool, all of those expenses that support your agency as a whole. Which bills am I going to pay? And I've decided that I'm going to pay my accounting bill and my general liability insurance. That's a manageable way to identify the indirect costs that I'm going to charge to this agreement. So here's your total MTDC with all of these exclusions calculated in there. That's the de minimis rate that I'll be updating. That's the maximum indirect cost that you can charge to this agreement. Did that generate any questions, Aisha?
Definitely. So the first question, I think I answered already, and they were asking the portion with the contracts and assessing modified total direct costs. Are they talking about contractors and subawardees or subrecipients, or just one or the other? And the
Both.
answer to that is both.
Yeah.
Um, someone said, okay, maybe they were answering somebody else's. Is this the grant budget, or is this the organizational total budget that
Grant
you're
budget.
referring to?
The
Grant
grant
budget.
budget.
Okay. How do we report indirect costs in our PFRs? Should we include it based on the month's total modified total direct costs, or the expected average modified total direct cost over the performance period, or in relation to actual expenses? And this is for a monthly standard reimbursement grant, not quarterly or working capital advance.
Right. It doesn't matter what your reimbursement method, or dispersal method, I should say. It doesn't matter about the dispersal method. It doesn't matter if it's quarterly or monthly reporting. You will report indirect costs on your PFR when those costs are incurred, when you pay that bill.
Right.
So that's why you want to be thinking about what's the simplest thing, how I can structure the indirect cost bills I'm going to pay to make it manageable for you, because you're going to be reporting it not 10% off the top of all the direct that was incurred that month. You're only going to be charging it indirect when you pay an indirect bill.
Yeah. And the amount that's in indirect doesn't change month to month. So I think that what you were maybe implying there, Eric, was like, should you include it based on the month's modified total direct cost? And, the percentage and the amount wouldn't change after the budget is approved in that way. But like Maureen said, you would only report it or ask for reimbursement for it when you've paid the bill that you outlined that you would pay utilizing that line item.
Right. So that's why I use two different examples for the indirect costs. The accounting service is probably a monthly charge that you pay, right? You'll see in the sample budget that I'm gonna send you that we describe that accounting service as doing monthly, reconciliation for you. So they're gonna look at your books every month and make sure that they're good. So that's an ongoing monthly charge. So when you pay that monthly accounting bill, you can charge that every single month because you incurred that cost and paid it out every month. Your liability insurance, you probably only pay a couple of times a year, right? So you're not going to charge that liability insurance every single month, just when you pay the bill. But before we go into that detail, I do want to talk about a little bit more about the changes to the indirect costs. And this is really important because you submitted a budget based on the old rules. Now the rules are more generous. The de minimis is up to a maximum of 15%. They are excluding a higher amount, they're excluding a lower amount from any subawards or subcontracts. That's more generous. This calculation would change and give you more indirect costs that could be charged to the agreement. The thing is that since this is kind of happening midstream and we have to allow that, we're not going to be increasing your designation. So you're still working within the same amount that was awarded to you that you may have calculated on that other guidance. And even though the guidance has changed, the award amount is not being adjusted. We've already spent all the R3 cohort 3 money and spread it across 88 agencies. Though that dollar value is not going to increase. So if you are seeking to use this higher de minimis rate, or if you're seeking to include a higher value in your in that MTDC because that guidance has changed, it's excluding a lower amount from your MTDC. You have to find that money in the the amount that's been awarded to you. So,
Can I flag one more thing, Maureen?
yes, please.
So in addition to that change on October 1st in indirect, there's also a change in the amount for subawards or contractual. So that increases from $25,000 to $50,000. So just keeping that in mind as well. So if you all are wanting to, again, increase to the 15%, then you can work with your grant specialist within your current designated budget to make the adjustments that you would like to make to have that increase. But you don't have to take it
That's
also. So
correct.
you can stay at 10%. You can also take less. You don't have to take 10%
Right.
if you only feel like you're going to need 5% because you're just covering your accounting and that's it. You can take 5%. So it's not required for you to take 10 or 15%. You can take less if you want to, just to account just for what you need. It is not required for you to take the maximum.
Exactly. I bet we had some questions on that.
So, should we use round numbers?
What you don't have to use round numbers. I mean, you do the calculation, and that will tell you what's allowable. Um, as Aisha said, you could use a lower number, but to round it off. But I would round down if you're going to round down, not up.
Mhm. If we budget a specific amount for subcontractors, then not use it, can it be used in the personnel budget?
You would have to do a budget revision for that. Any change to your, like, reallocating money after the grant has been executed, don't do it until you get a budget revision approved by your grant specialist.
Or at least contact your grant specialist and talk to them about what you intend to do, because there is some flexibility depending on the amount. Is that correct, Maureen?
Yeah, I mean, there is a threshold, but, and I think that's good guidance to always talk to your grant specialist first. But if you say, well, I'm not going to use that $100,000 contract after all, so I'm just going to hire 4 other people, don't do that. I mean, that would be a significant change, and you would need to get a formal budget revision, and don't incur those new costs until you have it, because that would be disallowed.
Correct. If this is the only funding your organization has, can the entire budget be charged as direct costs? Yes, and I would recommend that.
But
So
with
that was
the
Jada Smith.
yeah,
Uh,
but with one asterisk on that response, Aisha, for the executive director, there are like we talked about last week, there are limits
mhm,
to what you can charge an executive director or other administrative staff, um, as a direct cost.
right. But you do not have to request indirect. It's not a requirement.
That's
But some
correct.
organizations that utilize multiple funding sources to fund their programs normally take indirect. But if you have one single funding source, then you can have all of your expenses be direct costs and not look into utilizing indirect. It's not
Right. Because those costs are going to be directly attributable. If you're operating one program, you know that all of your costs that you're incurring are about this one program, right? So that's directly attributable, so it's a direct cost. It's that simple. So let's move on a little bit because we just have a couple minutes left. Um, so as I said, indirect costs charged to the agreement have to be actual expenses that are paid. It's not like just a 10% bonus on top of all of your direct expenses that you're reporting. And you charge those indirect costs when you pay those indirect costs. So here are a couple examples. We've kind of talked a little bit about this. I have that accounting service, which provides monthly accounts reconciliation. The question is, when will these costs be charged to the agreement? Because they bill every month for those accounting services, and you pay that bill every month, and that's included in your identified indirect costs that'll be charged to this agreement, then you can charge that bill every month on the indirect line on your PFR. Now, in the other example is that the general agency liability insurance, but that insurance is only paid in January and July. So you're not going to be including this on your August bill. You're only going to be including the liability insurance as an indirect expense in January and July when you actually pay for that insurance. I mean, I should have said June. Sorry about that. I misspoke. So, like I said, that financial documentation checklist that we're going to tell you, that we're going to send you, may also be a valuable tool to keep track of when you incur those indirect costs, when you are paying those indirect costs, and making sure that you're maintaining the adequate documentation for when you expend those costs. So, as always, we have this Qualtrics link. I'm going to include it in the follow-up email as well, because we really want this training to be effective for you, and we're really open to your input. We want to get your feedback to see what we can do better, and we want to make sure that it's effective for you. The upcoming trainings tomorrow, we're going to talk about dispersal methods, and we're going to be talking about stop pay. Next Wednesday, because we're going to, working capital advance is one of the dispersal methods we're going to talk to you about tomorrow. And it is, can sometimes be the most challenging dispersal method. We're going to spend all of next Wednesday just talking about how working capital advance works. And now I'll stop for the rest of the questions.
Really, there aren't any additional ones in the chat, Maureen. I think we may have missed one from earlier, and that was how do we determine the difference between who can be listed as a contractor and who would be considered indirect. So, example from your sample, the accountant is a direct expense, but he, she, they would not be paid out of my indirect.
So this is an accounting, in my example, that accounting service serves the whole agency. And it's included as an indirect expense because it's hard to figure out exactly what share of their bill every month is directly supporting just this, the accounting for just this one program, as opposed to all of the accounting, agency-wide accounting that they do for them. So that's why it's an allowable indirect expense. But in my other example, where you have an accountant, a part-time accountant on staff, and then you get this R3 grant, and now you're going to increase their hours so that they can work specifically on this big R3 grant. That's a direct expense. You can directly attribute it to this grant program. So I would not want it in the indirect. What else you got?
Last question. Anything to worry about regarding supplanting grant funds?
Supplanting is allowed under R3. Is it not, Aisha?
It is.
It's typically our federal awards that have strong prohibitions against supplanting. And supplanting is when you are using this new grant money to pay an expense that you were already paying before. So the federal funds typically prohibit supplanting because those federal dollars are supposed to increase your capacity. So you're already responsible for that expense. Now the grant can only supply additional resources, not pay an existing expense instead. But supplanting is allowable under R3, so no worries.
All right. I think, is it prohibited to place grant funds in interest-bearing accounts?
No, it's not prohibited. Actually, in some of our federal awards, we're required to place the grant funds in an interest-bearing account. It's not prohibited and it's not required for R3, but if you get a large amount of income based on this, that would count as a program income. But as we'll discuss tomorrow when we talk about the dispersal methods, the way that we disperse funds is that you're only supposed to have the funds that you need to operate the program. So you're not going to be sitting on a big chunk of money that's going to be earning significant interest that would that you'd have to report to us. So we'll talk about that in great detail tomorrow, and I'll make sure that I bring that up in tomorrow's training.
All right, there are no more questions, and we're out of time.
Great. Well, thank you all for joining us. Keep an eye out for the follow-up email, and let us know if you have other folks that you want to add to our contact list. It's going to take me a little while to update that MTTC tool, so it'll probably come a little bit later today, but I appreciate your time.